Global markets continue to play their inflation games. Hodlonaut's quest for justice continues in a Norwegian courtroom. And Giga Chad Michael Saylor doubles down and prepares to buy the dip.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
You know, the thing about doing a weekly podcast is that I spend all week, pretty much from the minute I finish the podcast up until I'm ready to start recording, taking notes about what it is that I want to talk about on the next show. But without fail, that list just goes straight out the window. And as usual, it seems that the big news right now continues to be the price. I guess that's a lifelong saying, as the saying goes. The news is the price and the price is the news. And that certainly is the case this week. Although, as I mentioned in the lead-in, there are several things that I do want to discuss besides price this week, and not the least of which is the CSW Hodlonaut trial and some other interesting news out there if we get the time. But before we get into all that, let's take a quick look at the vital statistics. Today is Wednesday, September 14th, 2022, and that means it is DCA Wednesday. And we currently find ourselves, at the time of this recording, at a block height of 754,081. And Bitcoin is ringing in at $20,245 US dollars per Bitcoin. To some of you, if you've been following prices, that may seem like that's been a dramatic crash. But if you've been following us on Wednesdays and doing your DCA stack on Wednesdays, that's actually up about $1,000 from where we were last Wednesday. So once again, that proves that perspectives are completely relative. Nonetheless, $1 will currently score you 4,939 sats, 49.39 Moscow time. And if you value your wealth in shiny metal rocks, it will cost you 11.9 ounces of gold to buy just one Bitcoin. That's actually as expensive as we've seen Bitcoin in gold terms in over a month. We have to go all the way back to July before Bitcoin was more expensive than that. It was 11.2 ounces of gold to buy one Bitcoin last Wednesday, for example. One Bitcoin will currently buy you 1,213 Papa John's pizzas. And if you value your wealth in oil, it will cost you 212.79 barrels of oil to buy just one Bitcoin at a price of 469,896 sats per barrel. Bitcoin's market capitalization is up markedly since last week, about a little over 20 billion, that is, currently ringing in at $387.7 billion. That's obviously nowhere near that 1 trillion market cap that we had seen during the double top of the last part of this bull run, or the last bull run. But still, 20 billion more than just last Wednesday. The mempool has been on again, off again. When I was looking at the mempool yesterday, there was quite a bit more on-chain activity than there is currently. Right now, there are a little over 1 block's worth of transactions pending in the mempool. And as a result, it's suggesting that the fee estimator is saying that it will take a fee of 13 sats per byte to guarantee that your transaction on-chain is included in the next block. Although I think that that's dubious because I've seen that mempool clear out a couple of times while I've been doing prep for today's show. And so I think 1 sat per byte transaction should clear, if not the next block relatively quickly, certainly within a day. That's the transaction volume that I referenced just a second ago, that metric I like to follow, the on-chain 24-hour transaction rate, is up a little bit from last week. It's currently zooming along at 3.11 transactions per second, which is above the 3 transactions per second I like to see. But right before Bitcoin had its big price drop yesterday, it was above 3.25 transactions per second. So again, my observation on that metric holds true, that when it was 3.25 transactions per second, Bitcoin was climbing, and then it dropped down below 3 transactions per second when the price of Bitcoin corrected yesterday afternoon. Since we spoke last, the Bitcoin mining difficulty was increased by 3.4%. That's a fairly substantial increase. As you know, Bitcoin adjusts its mining difficulty every 2016 blocks, which is theoretically every 2 weeks, but it's basically it's 2016 blocks, however long that takes, regardless of whether that's faster or slower than 2 weeks. Sometimes it comes in. Well, when hash rate is continuously increasing, it often comes in faster than 2 weeks. We're currently 1,919 blocks until the next mining difficulty adjustment, so this epoch has just barely gotten underway. That's still over 13 days from now. It's estimated to occur on the 27th of September, and estimations are all over the place, as you would imagine, since it's only been a couple of blocks since the difficulty was adjusted. So they're really not worth paying attention to, but I'm going to read them anyway. And where I get my data is looking at anywhere from a decrease of 1.24% all the way up to a decrease of 19.7%. And that's because the few blocks that have come in this epoch are averaging 12 minutes and 25 seconds. And that is substantially longer than that 10-minute goal. Ergo, they're forecasting a difficulty decrease. Of course, it's way too early to determine whether we're even going to have a decrease, and if we do, what the size of that decrease will be. Maybe by next Wednesday's episode, we'll have a little bit better idea. But if you're into mining, that's an important statistic for you because it determines how profitable your mining is going to be. All right, back to the news, the things that I wanted to talk about. Well, not the things I wanted to talk about. Back to that price issue. The stock market absolutely tanked yesterday after the consumer price index came in at a whopping 8.3%, which was much higher than the anticipated 8% or so that all the Wall Street strategists and economists had been widely expecting. As a result, the Dow plunged 1,276 points, or 3.9%. The S&P fell 4.3%. And the NASDAQ, where most of the tech stocks are, tanked 5.2%. This, of course, comes as the Fed is set to release its decision on interest rates next week. Until the CPI news, the general consensus was that we were looking at a 75 basis point rate increase. That's 0.75% increase in interest rates. And that was, I forget what the Vegas betting odds were, but it was somewhere around 80% likelihood odds that we were going to see a 75 bips rate increase. Although there were some that were hoping for, a slight, not a decrease, but a decrease in the rate of increase with only a 50 basis point rate increase in the realm of possibility. Now, however, with that hot CPI number coming in, a 75 basis point increase is pretty much expected, with some people even fearful of a full 1% rate increase on the table. Of course, as you know, if you're an Austrian economist, or if you have been in the Bitcoin scenario long enough, in the Bitcoin realm long enough, you know that basically that they're just playing games over at the Fed, that the real cause of this inflation that we're dealing with has been the rampant money printing, not just QE dating all the way back to 2008, but the tremendous amount of money that was printed after the quote-unquote pandemic, and even the Green New Deal, which was laughably entitled the Inflation Reduction Act. In fact, every time you read the news, there's another huge spending proposal. The last one I saw says that Biden is getting ready to unveil a $900 billion plan, infrastructure plan. I forget what the details were, but the point of it is they're throwing around numbers that are almost trillions just on a daily basis, and that is why we're dealing with inflation. Of course, the way that the Fed hopes to get inflation under control is by crashing the economy. The theory being the supply and demand, one half of supply and demand being demand, and if they put thousands or millions of people out of work, well, then they won't have any money, so they can't spend any money, and therefore inflation will slow down. And that certainly is the case. Crash the economy into a recession or depression, and you'll probably, hopefully, get inflation under control. while ignoring the initial and the fundamental cause of inflation in the first place and scapegoating interest rates, for example. Anyway, as I mentioned earlier, if you've been focusing on the price and trying to trade, you certainly have one worldview, because just yesterday Bitcoin was several $1,000s a coin more than it is right now. But if you've been following us on Wednesdays and making your stack every Wednesday, Bitcoin's actually more expensive today than it was just last Wednesday. So, that's one lesson that we've learned just in this year, a little over a year that we've been doing our DCA Wednesday episodes. In addition to the price being basically a couple $100s more than it was last Wednesday, it's still right in the middle of that $20,000 to $22,000 price range that we've been in for months, literally since like basically just after June. All of this, of course, is a reminder that we are still early. As I mentioned in our previous episode, when I mentioned the guy that was on Reddit asking if it was too late and if only $20 a month was even worth his time. Guys, Bitcoin's only $20,000 a coin right now. Not only is that nothing compared to where it's going to be after the next 2020, after the 2024 halving cycle and the halving cycle after that, all it has to do is go back to its previous all-time high, and it's going to be 3 times more valuable than it is right now. Even if you don't think you're early, just moderately early, if you're a follower of Adam Meister's 210,000 block theory, which basically says that at any point in time, Bitcoin is more expensive than it was 4 years ago. So 4 years from now, Bitcoin will be worth more than it is now. 4 years from basically when we set our new all-time high, Bitcoin will be worth more than what our previous all-time high was. We're still early. And Bitcoin Lebowski summed this up great earlier today on Twitter. If you're not following Bitcoin Lebowski on Twitter, you need to. He's got 9,000 or 10,000 followers, so chances are you are following him. But if you're not, he's at Dude J Lebowski on Twitter. And he tweeted this morning, or late last night his time, depending on how you look at it, "Can you imagine the release of pent-up demand once central banks finish playing their Keynesian games? The next bull market could be unlike anything we've seen before." And they always say this time is different. And to some extent, they're right. This time is always different. But at the same time, we have seen that history does in fact rhyme, even though nobody could have anticipated the virus, and you could say nobody could have anticipated the economy tanking the way it has afterwards. But of course, if you had anticipated the virus and the government's no-brainer what the government's response was going to be, I guess you could have anticipated the results. But that being said, Bitcoin still has been following its traditional 4-year cycle, whether it's doing it slightly differently or not. Bitcoin has set a new all-time high shortly after every halving, and it's done that 4 times now, or 3 times now. We've had the 2012 halving, 2016 halving, the 2020 halving. So yeah, we're getting ready to have the 2024 halving less than 2 years from now, and the cycle repeats. And if the cycle repeats, you're early. That's all I'm trying to say there. And speaking of Twitter, Plan B is still defending his stock-to-flow model, tweeting on Monday, quote, "People ask if stock-to-flow model is still valid. I think it is. We can go technical on autocorrelation and co-integration, but key is, in my opinion, that Bitcoin price is not more/less off than in 2011, 2013, or 2017. In my opinion, stock-to-flow model is valid, and I expect to bounce back above the stock-to-flow model value before the 2024 halving." So even not taking into account the cycles that are the supply and demand cycles that revolve around the supply shock by cutting the reducing the amount of new Bitcoin mined and hence available for sale in half every 4 years. Plan B, still holding on to that stock to flow model, is predicting that we will bounce back above that stock to flow model line before the 2024 halving. Of course, only time will tell, right? And speaking of mining, for those of you who are mining at home, it is now official. Slush Pool is now Brains Pool. We mentioned that last week. It seems kind of a shame for them to change the name, but Slush Pool was purchased by Brains a while ago, and it's theirs to do what they wish. But if you are mining at home, don't worry. You don't have to do a thing. This was a change in name only, and all of your current settings will still work just fine. According to a statement from Brains Pool, quote, "As you may already know, in July we announced that we will be saying goodbye to the Slush Pool name. Well, the time has come. As of September 14th, our Bitcoin mining pool is renamed Brains Pool. As this is purely a renaming exercise, you do not need to take any action. The pool operations and the team behind the pool remains the same, and mining is not affected." So I'm going to say it again. If nothing's changed, why did they get rid of the name? It seems kind of like McDonald's saying, you know what, we're going to rename our restaurant to Brains, or Coca-Cola saying we're going to rename Coca-Cola Brain Soda, or whatever. When you got a brand name, particularly since Slush Pool was the very first mining pool, it seems like a silly move to throw that brand recognition away. But I guess it really doesn't matter. As I said, everything remains the same, and I wouldn't, as a miner, make my determination on where I point my hash power solely based on the name of the pool. So I guess the end of the era it's the end of one era and the beginning of a new era. So we will join Brains in saying goodbye to the Slush Pool name. And speaking of mining, we are mere hours away from the alleged completion of the Ethereum merge. Along those lines, Coinbase, of course, stands to benefit tremendously from as far as the amount of influence they will have over the Ethereum system, Ethereum protocol, by virtue of proof of stake and by virtue of the fact that a large percentage of ETH is held in account name in Coinbase, which means if you're staking on Coinbase, sure, you're going to earn interest on your ETH, but Coinbase gets to exercise all of the rights and privileges associated with staking that Bitcoin. And that, if I actually cared about ETH and I didn't want to see ETH fail, that would be very concerning. Of course, besides just giving them the power to control, to basically control your vote as far as, your ETH staking vote, you also won't be able to sell or trade your ETH until unstaking is accommodated, which as of right now, if you lock your Ethereum up and in order to earn interest, if you stake your ETH, they haven't written the code necessary to unstake it. Once you stake your ETH, it's permanently staked until they come up with a way to unstake it, which their best estimate is that will occur, quote, sometime in 2023. So again, this isn't an Ethereum show, but them foobarring this up, if they screw this ETH merge up, that will have such a huge impact on the quote unquote crypto sphere that it would definitely impact Bitcoin. And who knows how long it would take for Bitcoin to be able to recover from just the black eye that it would get, even though it had nothing to do with Ethereum and even though it has nothing to do with their POS merge. If they screw this up, if they screw this up, we'll be able to buy more Bitcoin at a discount price. But for those of you that want to see retail come back and those of you who want to see institutional trading pour into Bitcoin, if they F this up, it's going to be a lot longer before you see any of that, except for MicroStrategy, of course. And one of the things I wanted to talk about from last week was that MicroStrategy revealed in a filing on Friday that they plan to sell up to $500 million in stock for the purpose of purchasing more Bitcoin. The chatter around this has been mostly positive. I have seen a few people arguing out there that this will dilute shareholder value. The counter to that argument being that, they're spending this revenue on purchasing Bitcoin. So, while there would be more stock existing and therefore your one share would be a slightly smaller percentage of the ownership of MicroStrategy, from a shareholder value standpoint, even if Bitcoin just stayed the same in price, it would be net neutral. And if you're a believer in Bitcoin, as you should be, if you believe that Bitcoin is going to increase in value, any increase in value will be a corresponding increase in shareholder value in the long term. So I'm certainly not worried about diluting the shares. And it is really cool to see that MicroStrategy is doubling down, because if you remember a month or so ago when Michael Saylor stepped down as CEO of MicroStrategy, there was a lot of speculation that this was possibly the beginning of the end of MicroStrategy's Bitcoin strategy. And of course, he immediately said that was not the case, that this move was actually going to allow him to focus even more on Bitcoin. And it appears, at least, that that is definitely the case, because they're gearing up to buy $500 million more Bitcoin. And that is definitely putting your money where your mouth is. As I alluded to in the opening, the HODL CSW trial continues. There has been no major news to report thus far, with the minor exception that CoinDesk is reporting that CSW's attorneys say he will not be signing a message, which would be an easy and obvious way to conclusively prove that he is Satoshi, saying, quote, his scholarly work, personal history, and above all, his success at convincing Gavin Andreessen that he held Satoshi's private keys are proof enough. So that clown show continues in a court in Oslo, Norway. And again, other than the fact that CSW is just a black eye morally on the Bitcoin family, it's really moot. Who knows what his ultimate end game is? Probably just to stay out of prison in Australia. If you recall, they're investigating him for tax fraud in Australia, allegedly. And it's probably only a matter of time before those chickens come to roost. And every time he claims to be Satoshi, and every time he claims to have millions and millions of dollars in Bitcoin that he mined, I'm not an attorney, and I'm definitely not a tax attorney, but if you're out there bragging about that you have billions of dollars that you haven't paid taxes on, those chickens are going to come home to roost, Craig. Good luck with that, huh? All right, I don't remember who I heard this from first, but last week I heard somebody on one of the podcasts I listened to point out that there had been a huge drop in the number and dollar value of U.S. municipal bonds. As many of you either know or don't know, cities and states and school districts and fire districts and basically local governments smaller than the federal government issue bonds. They sell bonds as basically a promise to pay you back with interest, and then they use that money to fund things. According to a report in Reuters, U.S. state, cities, school districts, and other borrowers in the $3.8 trillion municipal bond market are selling less debt this year, with issuance dropping 13.1% to $210 billion through July 31st versus the same period last time. And yet another report states that August municipal bond issuance declined 23% year over year. Why is this a big deal? Well, it's a big deal for several reasons. First of all, according to the Tax Policy Center, state and local governments issue bonds to pay for large, expensive, and long-lived capital projects such as roads, bridges, airports, schools, hospitals, water treatment facilities, power plants, courthouses, and other public buildings. Or as the city of Austin put it on their website under their facts page, bonds give cities a tool to raise funds for capital improvement projects that are otherwise not funded by the city. So if cities are not able to sell or able or willing to sell bonds, there are capital improvement projects that are not going to be done. Roads that are continue to crumble. Water treatment facilities that won't be built or repaired. If you're in Michigan or Mississippi, you may live in a place where you already can't drink the water coming out of your faucet. And if your city can't issue bonds to keep those water treatment facilities going, that is a problem that may find itself getting more and more prevalent. More and more people subject to that. And the reason, of course, that cities can't sell bonds is because when they sell bonds, they're selling IOUs. You're giving them money and they're promising to pay you back at a future date plus interest. But with interest rates soaring, it gets more and more expensive for the cities to do that. They don't necessarily want to issue a bond that they have to pay huge interest payments on, as opposed to when interest rates were low and the money was practically free as far as the cities and states were concerned. Speaking of carnage in the quote-unquote traditional asset markets, gold took an absolute hammering yesterday, dropping briefly below the $1,700 an ounce mark. So much for the uncorrelated store of value, Shiffy? So much for the hedge against inflation, Shiffy? Because that drop coincided exactly with the announcement of the CPI numbers. I'd say that that store of value and hedge against inflation narrative is officially deceased as far as gold is concerned. Along those lines, gold is down 2.98% in the last 30 days and down 11.63% in the last 6 months. Now, I don't hold any ill will to gold bugs. I am a fan of gold. If I were not investing in Bitcoin, it would be my go-to, my second best choice. But you just don't need gold anymore. Bitcoin is everything gold is or was supposed to be, and so much more. It's easier, it's faster, it's more divisible. You don't have to hire armored cars to drive it around just to buy something with it. It's just so funny that so many gold bugs it's almost like they're just clinging and that they refuse to see or accept Bitcoin out of just sheer stubbornness or whatever people like Peter Schiff's reason is. Of course, he owns a gold sales company, so obviously it's in his best interest to be a Bitcoin hater, his financial interests. So, take that for what it is. All right. So all is not lost. As far as I'm concerned, there really isn't any bad news this week. The economy going to hell in a handbasket might be bad for the country, but it's certainly not bad for you as an investor. They say the best time to buy is when there's panic and blood in the streets. So whether you're investing in Bitcoin or the shitcoin of your choice, the best time to buy is when it's low. And Bitcoin is still low. It isn't a record low. Like I said, we're almost $1,000 more expensive than we purchased last week. But it's nowhere near the $65,000 that I think was our highest purchase, the most expensive we purchased during this dollar cost averaging series of podcasts we've been doing. And along those lines, let's get right into it. What is DCA, you might ask, if you're not familiar? DCA is short for dollar cost averaging, and dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, this will be our 60th stack. We started stacking just $20 every Wednesday back in July of 2021. And that's so far we've stacked 59 times. And the reason we chose $20 was twofold. I wanted to show that, first of all, that it's not too late, that even for those people out there that say I only have $100 or only have $50, or yes, I only have $20, that even investing just $20 a month over time will add up. And in just a little over a year, at just $20 a stack, we've stacked 3.2 million Satoshis. And I don't think that, when we do hit hyper-Bitcoinization, whatever Bitcoin ultimately goes to as far as the moon is concerned, let's say Bitcoin hits $1 million one day, Bitcoin hits $10 million one day, whatever the case may be. If Bitcoin hits $100 billion, every single Satoshi will be worth $1. And that's who knows if and when that would ever occur. But, if we do hit $100 billion Bitcoin one day, that 3.2 million sats is $3.2 million of the Bitcoin. Wishful thinking? Pie in the sky? Who knows? But if you'd told the average person that Bitcoin would be worth $20,000 a coin 10 years ago, there's very few people that would not have laughed at you. All right. So before I let the price of Bitcoin change a whole lot more, we're going to get our stack on. And as usual, we're going to stack using the handy dandy Cash App. Cash App may or may not be available where you're at. Do your own research, as they say, and use the app or the exchange of your choice. But I find Cash App is the easiest way to stack Bitcoin, especially in small amounts like $20. It's not necessarily the cheapest way to stack Bitcoin. So if you're going to make larger purchases, you might want to find a exchange that charges lower fees. But for us, we're going to stack using Cash App. And if you don't have Cash App and you want to use Cash App, there is a referral code in the show notes. Clicking on that will get you $5 free for signing up and using Cash App, and we'll get $5 free too. Cash App is not a sponsor of the show. Anybody that uses Cash App has a referral code for referring friends and family members. If you sign up for Cash App, you'll get one as well. But by using our referral link, you're basically tipping us $5, and not only is it costing you nothing, you're getting paid to tip us $5. So we both benefit. So if you do want to use Cash App, please consider clicking on that link. All right. So one of the other reasons I like Cash App is I usually don't keep any money on my Cash App, but they make it super easy because I have a debit card linked to Cash App, so I can add $20, and it is immediately available to do whatever I want with. And so I go over to Bitcoin, click buy, click $20, click confirm, and boom, just like that, we purchased another 96,839 sats. Not quite as many as the 101,581 sats we scored last week, but pretty darn good nonetheless. And perhaps most importantly, that is going to lower our average cost basis again. That has lowered our average cost basis by another $446.89 to $35,712.21. That's knocked almost $1,000 off our average cost basis in just the first 2 weeks of September, which is pretty cool. And that's one of the neat things about dollar cost averaging is we've bought the highs and now we're buying the lows. And the longer the price of Bitcoin stays lower, obviously the more Bitcoin we're going to stack per dollar, and the lower it's going to bring our average cost basis down. So we are currently in the red. Bitcoin has to go above 35,712 for us not to be in the red. But if you are into Bitcoin, if you're a believer in Bitcoin, I don't think there's any doubt in any of our minds that it's not going to be substantially more than that. And the longer it stays cheap, the better, because, after the first new all-time high when we hit $66,000, in April, and all the way until Bitcoin declined after that $69,000 peak last fall, I was looking at my stack and thinking, what if? And it's not one of those what ifs where people are like, man, if I had only known about Bitcoin 10 years ago, I'd be loaded right now. I knew about Bitcoin, not 10 years ago. Actually, I did, but that's another story. But just last year when Bitcoin was $3,000, before it exploded after the halving all the way up to $69,000. And I didn't stack enough $3,000 Bitcoin. Obviously, looking back at it now, I didn't know it was going to go up. I guess I should have known it was going to explode to a new all-time high. I knew that it was going to explode to a new all-time high, but I don't know what I was thinking, but whatever it was, it didn't involve stacking enough sats. My point being, 4 years from now, we're going to be in another bear market probably if history repeats. Bitcoin will have set a new all-time high, and it will have crashed by 60 or 70% or whatever it does again. And God only knows what that'll be, but let's just say it's $120,000 just for giggles, right? It'll be sitting at $120,000 thinking, I can't believe I didn't stack more $20,000 Bitcoin. What was I thinking? I knew it was going to do this, and I just didn't stack hard enough. Guys, don't let that be you, because you don't have an excuse. You can't say, if I only knew about Bitcoin, because you're listening to this podcast, you've fallen down the rabbit hole, or at least you're falling down the rabbit hole. You won't have an excuse, at least not one that you will accept, not one that you could tell yourself, and you will be kicking yourself and regretting every sat you don't stack. And will Bitcoin go lower? Maybe. Who knows what's going on in this world right now? Maybe the stock market will crash another 50%. And maybe we'll end up in another Great Depression, and maybe the price of Bitcoin will tank all the way down to $10,000. Who knows? But one thing I do know is that it will return and set a new all-time high. As Adam Meister again always says, Bitcoin always returns to its all-time high. It's only a matter of time before it sets a new all-time high. And when it does, whether you bought at 20,000 or 10,000 really won't matter. All that will matter is how many sats you stacked. And to that extent, we have increased our stack to, we were at 3.1 million. We've got 3,336,195 sats. And even if Bitcoin doesn't go to dollar sat parity, even if Bitcoin just hits $1 million, let's say $1 million is the moon, that's $33,601.95 worth of Bitcoin. But more importantly, it's $3.3 million worth of sats that we stacked in the $20,000 range as opposed to the $1 million range. All right. If you have been enjoying the show and you want to follow us and hear more of what we have to do and say, one of the ways you can do so is by following us on Twitter. In fact, if you're on Twitter, please follow us on Twitter. We are at BTC Bulletin Pod. That's at BTC Bulletin on Pod, or BTC Bulletin Pod on Twitter. And we don't have a whole lot of followers on Twitter right now, and I would like to increase that number because the more followers we get, the more people are going to see what we have to say, and the more people that see what we have to say, the more people are going to be orange-pilled, and that's better for all of us. Also, if you would like to contact us and let us know what you think or what you like about the show, what you don't like about the show, you can DM me on Twitter. I don't get into my DMs a whole lot because there's a lot of spam, even though I don't have a ton of followers on that Twitter account. I do get a ton of spam every time I post. This, even as small a channel as we are, there's bots that automatically respond to everything we post. And it's the same way with the DMs. So the best way to get a hold of me and let me know what you think is by email. And my email is bitcoinbulletin@protonmail.com. So again, we're at BTC Bulletin Pod on Twitter, and our email is bitcoinbulletin@protonmail.com. And besides liking us on Twitter, I have one more favor to ask for you. And that is this podcast needs ratings. It doesn't have bad ratings. It just doesn't have ratings. Apparently, most of the podcast servers, regardless of where you're listening, whether you're listening on Apple Podcasts or on Spotify or even Amazon Prime Music, they require a certain number of you like and or rate a show before they will display a show rating. And you know that everything out there is driven by an algorithm. So please help us out as far as fighting that algorithm goes. And please, wherever you're listening to, give us a rating. Obviously, a 5-star rating would be awesome. Thank you. But any rating helps because the more ratings we have, the more likely we are to get featured. And the more we are likely to get featured, the more people are going to listen to what we have to say. And the orange pilling cycle continues. All right. Well, that's going to do it for this week. Hopefully your stack is bigger than it was last week, and hopefully it will continue to grow. Don't forget to buy the dip. Just because you're DCAing with us on Wednesdays or whatever your own schedule is doesn't mean that when Bitcoin does sink, does go down, does tank like it did yesterday, that you can't snap up some extra sats. In fact, one of the cool things about Cash App is they let you set custom orders. And I had a custom order set for $19,600, and it triggered while I was at dinner last night. So I stacked some extra sats on the side. We are not including those sats, as you know, in our DCA stash because that would taint our data. So for the purposes of this podcast, the only sats we're counting are the sats we stack as part of our DCA Wednesday purchases. And along those lines, we're going to continue DCAing every Wednesday till Bitcoin either hits the moon and we're all filthy, stinking rich, it crashes and goes to zero, or you just get bored and stop listening. But until then, keep on stacking those sats, you sexy sat stackers.